Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, this is Quincy Krosby, and this is The Talking Point. It's Monday morning, and it is August 15th. Thank you for joining me. I appreciate it. The market moved up. It crossed that 50-day threshold of 90% of the S&P 500, passing its 50-day moving average. Extremely good news for the market. And yet, there's consternation, concern that maybe we will see a pullback this week. So is that normal? Do we normally see that? Well, yeah, the market has to digest many of the gains, but a couple of things that are important here. And one is that when we entered the week last week, the market was technically overbought. And in my call, I mentioned that when you have an overbought market, normally the market wants to pull back. Something happens and the market pulls back because it is, again, overbought. Now, last week, the market moved ahead regardless. And I did mention in the call that when you have a market that defies the overbought status, that continues to move higher regardless of the fact that it's overbought, it's a good sign. Obviously, it's a good sign for obvious reasons. Now, one thing that we are looking for, and that is more enthusiasm for the consumer discretionary sector. And why? It's because 70% of our economy comes from consumer spending. We know from what the banks have said, what MasterCard has said, that lower wage earners are struggling. They are using their cards to pay off bills, and we know that money is coming out of their savings. We know also that oil prices, gasoline prices, while they've come down, they're still high, and rents are still high across many pockets of the country. So for the lower wage earner, it is about rent, it is about mortgage payment, it is about transportation, and it's about food. And food prices, as we saw from the CPI, continue to climb. One of the reasons, by the way, for that climb, you could go online and read about it, happens to be that fertilizer prices are still very high. Part of that comes from the war in Ukraine. Ukraine, not just being, major grain supplier, but that region between Russia and Ukraine providing much of the minerals and that are used for fertilizer. So that's the reason that we're seeing fertilizer costs skyrocketing, and it's therefore obviously feeding into, if I can use that pun, into food prices. So in any event, this week, we will have confirmation, we hope, about the consumer, because this week it is retail sales. We're going to hear from Walmart. We're going to hear from Target. We're going to hear from Home Depot. And we're going to hear what they have to say about the U.S. consumer. Again, based on reports from the banks, based on reports from the credit card companies, higher-end wage earners continuing to spend, not just on, bills and so on, but how do I say this? Enjoyment, going out, traveling, having dinner out, just that what we call the experience spending. Now, also about this week, and I want to go over that, we have quite a bit of data coming out. And that data will begin today. We will begin the National Association of Home Builders survey. It's going to be very important. Also, the Empire Fed manufacturing report. This is the beginning of that round robin that we have across the United States, where the Federal Reserve banks come up with the manufacturing reports in the region. Now, the Empire Fed survey is not typical of the rest of the country. It is New York, New Jersey, and Connecticut. But we will look to see whether or not their input costs are coming down, whether or not they have new orders, and what are their hiring expectations. The one following this is the Philadelphia Fed survey. And that has a bit more of a positive correlation with the rest of the United States. So we'll be watching for that. But we start that new round about, manufacturing across the United States. Also today, and I don't usually mention Federal Reserve speakers, but about 10:50 a.m. Eastern Time, the Federal Reserve Governor Christopher Waller will be speaking. I mention this because, he turned around markets the last time he spoke, in which he mentioned that he did not think the U.S. was in a recession. You may recall that we had the 2 consecutive quarters of negative growth, and he gave a speech, and he said, no, I don't think so. He said, I want to see where retail spending is. I want to see the labor report. He said, if you have a strong labor market, it's hard to think that you have a recession. And he said, also, I want to see where retail spending is going. His comments actually had turned around the market when he spoke. So I want to listen to what he has to say today at 10:50 a.m. Eastern Time. And then tomorrow on Tuesday is going to be a busy, busy day. We'll hear from Walmart. We'll hear from Home Depot. Now, what we're looking for is that perhaps the worst case scenario, the bad news is already embedded in Walmart. Last time I read a report about Walmart, they did mention that they were seeing a pickup in back-to-school sales. That's always important. We tend to look at back-to-school sales, collectively around the U.S. as a harbinger for holiday sales. And what do we know about holiday sales? Well, they are the sales that tend to turn back up and give the U.S. retailers going into the black from the red, where they're losing money and then suddenly they come back up and their bottom line is moving higher. So we always look at back to school sales, again, as a precursor to the strength or weakness in potential for holiday sales. We'll see building permits also and industrial production. And then on Wednesday, we get Target, we get Lowe's, we get Cisco, and we get TJX, which of course is a broad number of stores and brands under the TJX umbrella. Again, offering more atmospherics, more data on how are Americans spending and what are they spending on. And then also we will get retail sales, which of course will be important. Also on Wednesday in the afternoon at 2 o'clock Eastern, I mentioned the time because it could move the markets a bit. It will be the Federal Reserve minutes from the last meeting. What the market is looking for, now remember, we've had an awful lot of Federal Reserve speakers since that meeting suggesting that the market misread Chairman Powell. That was the suggestion, that there are going to be more rate hikes. Get over it, market. There will be more rate hikes and perhaps even into 2023 rate hikes. Remember, the market had originally been thinking that we would see rate cuts in 2023, perhaps because we would be in a recession and that the Fed would start lowering rates. Well, we want to hear what the minutes have to say. We want to see what they have to say in terms of what the thinking is about rate hikes going forward. Again, much of this is actually old news because we hear from the Federal Reserve speakers on a day-in, day-out basis. Then on Thursday, we're going to get the Philadelphia Fed manufacturing report. Again, what are we looking for? New orders, hiring expectations, and any other questions that have been asked about inventories and about also deliveries, because we're looking to see how supply chain challenges are easing. And obviously, that's very important. And then the market is going to be focused on news out of China. Now, this is important. I'm going to mention it today because the news out of China has been weakness across the board, except perhaps for exports, which is interesting because exports, usually are predicated on their manufacturing. And yet industrial production, factory production is down year over year, but also weaker than the month before the July report. Also in the reports coming out of China, we are seeing the slowdown in the real estate market. The real estate market is under tremendous pressure as construction has basically stalled. Folks, this is for the retail part of the real estate market. In China, you pay for your condo before you move in. And what's happening is Chinese are saying, no, it's not finished. How can I move in? And they have stopped paying their mortgages. This is a major problem in China. Obviously, much of this has to do with their COVID policy, zero COVID policy, where they are shut down areas of China until there are no cases of COVID showing up. But nonetheless, the Chinese authorities have to deal with this. And so far, it doesn't look like there's much help coming from Beijing. Although today, the People's Bank of China, which is their central bank, has lowered the rate that they offer to banks across the country. This helps provide liquidity in the local banks. By the way, this would be the first rate cut from 2.1% to 2% since January. Now, the market is expecting more from China, more stimulus going into the Chinese economy, perhaps with infrastructure spending. They mention that, but we haven't seen any follow through. That said, the next meeting, the major meeting of the Communist Party, will come in November, most likely, unless COVID hits. It's supposed to be meeting in Beijing. And the question is, what are they going to announce in terms of stimulus for the economy? And by the way, it's an extremely important Congress, that's what they call it, for President Xi, because he expects to be anointed with another term. Now, it doesn't mean it's going to happen. The Chinese Communist Party, the Politburo, doesn't necessarily have to do it. It would be that he's going to be pushed out. But the expectations will be that he does win another term. And so what we do expect is that perhaps between then and now, that other announcements are forthcoming in terms of how to help and underpin and help foster growth in China. So this is all because I want to mention that you may have seen this morning that oil prices have tumbled. They tumbled coming out of that data release out of China. That we saw retail sales down, we saw industrial production, factory production down, and obviously China, the world's second largest economy, has a major impact on everything, but oil prices especially. They are a major importer of oil. Much of it comes from Russia, by the way, but nonetheless, because we have a spot market world, global spot market for oil, it does affect the price of oil. Now, maybe we'll see oil prices pick up again during the day, especially this week, if it shows that the U.S. economy is moving ahead and growing. And again, retail sales matter, and all the reports that I mentioned, particularly with manufacturing. I also want to mention that even though oil prices themselves, Brent, which is the global benchmark, and West Texas Intermediate Crude, WTI, which is the benchmark here in the U.S., we're seeing, by the way, we're seeing upgrades for oil companies. And this is interesting. As oil prices come down, we are seeing upgrades for a number of oil companies. I won't mention that here, but you could go online and look. So why the disparity? Well, the expectations are that global growth will start to pick up, even if we go out a bit into 2023. As the expectations are that the Fed finishes up raising rates and that we start, moving higher. So there's that disparity, oil prices tumbling, but at the same time, upgrades for the specific companies. Also this week, I do want to mention that much is focused on the Biden administration's initiative in terms of clean energy. We're looking, and also drug policy. I just want to mention that too. So please pay attention to the effect on the market in specific sectors. But overall, as I close this call, I'm looking for how consumer discretionary names are going to do. Also financials. Financials did well last week. This is very important because when rates rise, there's a certain level at which financials begin to pull back. And the reason for that is that if you believe that upward movement in rates is going to slow down the economy and slow down loan growth, and also slow down the ability of companies to pay back their loans and individuals to pay back their loans, then you see financials pulling back. But it was good news last week to see that financials were able to move higher. And I think that's important. I always look at financials. At the end of the day, the banks, whether they're the small banks, regional banks, and even the larger banks, they are the backbone of our country, along with, small business owners. So I follow what small business owners have to say. So all of this is what shall I say, guidance as we go into this week. Let's look at what the markets are doing, not what the headlines are, but what the markets are doing and which sectors are leading. Now, in closing, I want to mention this, and that is we have 90% of the S&P 500 reporting. And what I can tell you is that we are seeing 9.7% of growth. Yes, and this is important because the estimates coming in were dismal, absolutely dismal. And this is versus 5.6% estimates coming into the earnings season. In terms of revenue growth, which is all the sales that come in, right? We call it top line revenue growth. It was at 13.7%. Again, ahead of estimates that came in as we began this quarter. No surprise then that going into the third quarter earnings season, which will take time to get there. We're just finishing up the second quarter earnings seasons. Already the estimates are coming in lower and expectations are for more pressure on margins. What we are seeing, however, is that American companies are dealing with those margin pressures. How? Well, many of the biggest names are saying, we're going to have hiring freezes, or they're starting to target certain parts of their companies with layoffs. That's how they respond in order to maintain their margins. So in any event, we will listen to what companies are saying about how they are dealing with the higher costs of doing business, and we will see how the data unfold in terms of what Americans are doing. Retail spending, as I said, and we'll also see what's happening in the housing market this week. A lot of data on housing. So thank you very much. Please don't hesitate to call or get in touch. I will get back to you, but we have to take the movement in the market, the retracing of the 50% threshold, as good news. What we want to see this week is follow through. But remember too, markets need to digest gains. They need to be quiet for just a little bit before they get next move higher. But the market is also focused on the next level, which is the 200-day moving average. Thank you so much for listening. Have a very good week.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.